Welcome to another Market Insight, where we sift through the noise to get to the signal to give you actionable advice so you can make informed decisions. Joining this week to help us navigate the markets is Chris. Chris, what's going on in the market?
I have an outline today because we do actually have stuff that really flows together. And I considered starting with geopolitics. It would make sense to probably start there. But when we go through it, I think it makes a lot more sense to build up to it because the market's been reacting to a bunch of different news and in a way that may seem strange, but actually could be a little bit predictable. So we'll build up there, and it really all starts with interest rates. Interest rates are up big. That's why I put in a graphic. We haven't used, usually don't use that on our outline, and then we'll talk about the market, some really confusing jobs reports, confusing not just us, the whole market was very confused by it, and some seasonality and Fed speakers. All the Fed speakers have been out talking, trying to get their point across. A couple of them spoke multiple days in a row, public appearances, so we were laughing at that internally that, oh, if you didn't hear from him on Monday, you don't even have to hear him on Tuesday. Wait till Wednesday. He's talking again. And then I'll let you take geopolitics to close it out. So we'll look at the S&P 500, and that's really what we're looking at on top, about a 2-month chart. And last month when we met, we said it looked like the S&P wanted to move down to 4,200. Based on technical signals, there's the 200-day moving average and the 50-day moving average. We were pointing down there, but really when you look at it, what's actually happened? Interest rates. Mm-hmm. That's our bottom panel. The 10-year Treasury, used as what we use to discount future cash flows. A lot of people use the 10-year Treasury. Some use longer bonds, 20 and 30-year, but we use the 10-year. And it moved from the start of September at about 4.1 to the start of October, all the way up to over almost 4.8 and some intraday trading at 4.85.
Big move for the month.
Very big move. I heard a couple people on TV talking about it being an orderly move. I don't know what they were. It's a big move. I don't know if they meant orderly as in it was moving up every day, because that's really what was happening. And that's bonds selling off, rates moving higher. And what we can actually see on the right-hand side of the chart is the rates had come down. Yep. And once those rates put in a top, bonds putting in a bottom, we saw equity prices move back up. Those green candles moving back. That first large green candle was the jobs day. We'll talk about that when we get to jobs, but it was a very big move when the jobs were reported last Friday.
Which none of that is surprising to a CFA, right? One thing we know is that markets are discounting and they're using interest rates. So it's going to move in different directions based on the interest rate movement. And I think this chart screams that right. the market is basically discounting based on interest rates. So if interest rates move up and there's no change in the earnings, the market has to come down because of the way that's getting priced.
And it's a low news month, right? September seasonality is weak. There's not a lot to trade off of. Earnings season doesn't start until the next couple weeks from right now. So there wasn't a whole lot of company-specific news to help drive companies. Like you said, change in earnings would just be based on a handful of analysts that had changed their forecast. We hadn't changed anything internally with where we think that this quarter is going to be reported at. But I did want to zoom out because that's just looking at 1 month of interest rates, which are up. It's part of a broader move higher in total over the last 2 years, which is the dark blue is the 10-year Treasury, which we showed on the earlier slide, moving up, and the lighter blue is the Fed funds rate. So that's controlled by the Fed, setting their targets, and the long end is kind of mostly controlled by the market, and even with just a 2-year look back here, the Fed was still buying bonds at the very beginning. Remember, we were talking a lot about that 2 years ago. They were still buying bonds, which pushed down yields.
We had the taper and then what was the word? That was a big word then. I can't remember what it was. Basically, they were pausing and coming into that pause and starting to slowly walk into
it. It was the taper where they stopped. They reduced how much they were buying each month, stopped buying bonds, and then it was liftoff, which is when they took rates off of 0 and moved them up significantly higher. That was the light blue line on the slide, and probably should have put inflation on the slide, but it would have thrown off the axis a lot because the inflation was at 8% when they were raising rates that much. So this rate move is part of a broader move higher. Lots of reasons, right? They're raising rates on the short end. Some concerns about sticky inflation. We got an inflation report this morning, which was probably described as sticky. It was still elevated. coming down in the long term, but still not getting to the 2% target.
Right.
Right, annualizing a little bit higher than that. A lot of growth is coming in higher than expected, and then just positioning, right, with the Treasury issuing debt.
So the Fed has been raising wage. What are we seeing upcoming, right? Because that's really what we want to pay attention to is what do we think that the Fed's going to do going forward?
Right. And when we look at just expectations, so what is the Fed Fund Futures trading market looking at? You can look at the Fed has 2 more meetings this year, November and December. So I pulled December, and the range right now is 5.25 to 5.5 is where they've set the Fed Fund target range. And the majority of traders think it's going to fall in there, that there's no more rate increases for the year, but still a 25% chance roughly that there could be one more increase this year.
Right. And what impact is, we're talking about interest rates, and I think you mentioned that there's a lot of reasons. I'd say there's 33 trillion reasons to have the interest rates where they are. But we're seeing deficit spending continue, and we've talked about how interest rates are the mother of all arms, where most of it was short-dated paper. That's rolling off, and it's no longer under 1%. It's rolling into these 5.5. What's going on here?
Yeah.
How does this slide tell us what's going on?
Yeah, so a lot of people have been talking about the issuance from the U.S. Treasury. Now, sometimes the data is difficult to get, but you really also need to look at the retirement of debt and get that net issuance number to see, well, are rates moving higher for all the reasons we said, and also issuance is supply and demand.
Right.
Got to have to soak up some of that new supply. And the net issuance is the darkest blue line here. And we look the last quarter or 4 months, it's higher than the trend.
Right.
So there is significant new issuance hitting the market that needs to be purchased, and that's going to push rates higher.
And like you said, the supply, right? There's more to go. Well, then that means prices have to come down. With bonds, that means higher yields. And where we used to have a buyer when the Fed was building their balance sheet, now that they're selling into this, it just continues to exacerbate this issue with higher interest rates.
And
right?
not really that we would be allocating this way, but I talked to an allocator last week who was talking about buying Japanese sovereign bonds. They liked the yields there. Now, we probably don't like the yields there, but if they're a buyer of sovereign debt, they can look at, well, do I buy treasuries from the U.S. Treasury or I can buy it from Japan? Well, they were allocating to Japan. There's one less buyer, and that's obviously a small player, but it is true that there are new other opportunities out there for yield as well.
Next slide, we're talking about just the deficit and how this issue is going. With all these new higher interest rate bonds being put on, you would expect the deficit to go over because now you have a higher interest rate payment. But the CBOE is they have a different take on it. And can you kind of walk through that? Because I find this, I disagree with this.
I probably do too.
I hope they're right.
Yeah, I wanted to pull an alternative view, and this would be the bullish view for bonds to help interest rates come down, because we're talking, and everyone's talking about the new issuance that's hitting the market. Well, Franklin Templeton put this together. Similar way of looking at it. They're looking at the budget deficit as a percentage of GDP and saying, based on their forecast from the CBO, that they think it's actually going to come down, and that we're probably in a period of higher spending. I know I said that last
Certainly
week.
are.
Yeah, and that I guess they think it's not going to continue at this rate, which could happen. Like you said, you're not going to bet on this being a reason coming down for rates, but it is just an alternative view for what could
this
happen.
assumes a growing economy with tax receipts or interest rates decreasing fast enough to hit this impact, and I find this hard to achieve, and granted they're doing more number crunching than we are. They have a lot more, but there's lies, there's damn lies and statistics, and I feel that this is statistics for sure here. I hope it is accurate.
Yeah, I did want to just totally frame this move in rates. So we talked about that 10-year rate. On this next slide, that 10-year bond rate, our opportunity costs, and the bond we use to discount cash flows is in gold here. The top part is an implied equity risk premium, the premium in theory that you would earn for holding equities above the Treasury rate. And what we're looking at here is a long-term trend of where markets' expectations are going. So the expected return on equities is both of them combined. It's you get your premium and you get your T-bond rate. And what I wanted to show is when you're discounting cash flows, you have your numerator, your cash flows, you discount it with the required return for the index, and you get the price of the index. When we look, the bond prices, rates have moved up by over 70 basis points from the September to October, but the expectations on equities haven't really changed, which means the index has to come down.
Mm-hmm.
To get the higher required return, you're going to have lower prices on the index.
The denominator goes up, then the numerator, or what is it, the product? No, it's not the product, it's the quotient.
Yeah. And so all we're saying is that it makes sense with this large move in interest rates to affect stocks the way it has.
Right, and I think this is something else that we talk about is the volatility, the sell-off is painful, but that's actually how you generate return. We still are using capital market projections of 5 to 6% depending on equity allocations. This would actually suggest a much higher return.
Mm-hmm.
So right now, as bad as the headlines are, you're getting to buy these securities, if this is true, at a greater discount than what we've seen in quite some time. So this is the time to still keep that equity allocation and deal with the volatility, because you will get rewarded for that in the long term.
And so that closes out really the increase in rates that we've seen up until the first week of October. Then we get last Friday, that first green candle we talked about, that strong recovery where if you didn't really follow what was happening, you just, it's a good day in the market. That was the jobs release. We're looking at it here on the top is the change in payrolls. And again, we had a confusing number where the establishment data did not agree with the household surveys. And we saw a 336,000 increase in jobs, the largest that we've seen on the year. Their initial reaction when you see a large job number, because the market and the Fed has been talking about the Phillips curve. I don't think it's something you believe in with.
The 1970s says otherwise, right?
Right. But the market was following that because the Fed's been quoting it when they want to see jobs come in a little bit weaker because it means inflation will come in weaker and help with what they're trying to do to reduce inflation. So the initial reaction with this spike in jobs was a large sell-off, around 1%.
Jobs are up, we got to raise interest rates.
Exactly. When you look deeper at the number, like we said, very confusing number with lots of seasonal adjustments.
Call it statistics.
Yeah. Yes, some part-time work being thrown in there instead of full-time work, or actually more part-time jobs added. Seasonal adjustments, and you can look at average hourly earnings, which were coming down. It's a proxy for wage inflation. It's not a perfect measure because with the way they measure with substitution of the jobs, it's not perfect. But the market started to say, hey, this is not that bad. This is not extremely inflationary, recovered extremely strong into the end of the trading day. And that was really the start and the peak in rates on the short term, rates coming down for reasons that you just discussed, and the equity market's moving up.
So you've been talking about Fed speak and what they're talking about. Given all this information, what are they saying and how is it having that impact?
So then we show up on Monday, that was the Friday jobs, and we're obviously have a sell-off from Hamas over the weekend. And we'll get to that in a minute. But we start with the sell-off, and what was really credited with the recovery in the market was Fed speak. We had Vice Chair Jefferson saying that he's looking at tightening conditions from higher bond yields. So the market was very happy to see that they see the increase in rates. They know it's there, and they know the increase on the long end is going to tighten financial conditions. That was the slide I pulled in at the chart at the bottom, just showing on the very short term that when that's moving back up, conditions are tightening, and that was happening on the far right for the last month. And we got similar quotes. Again, Bostic, he talked every day, so we got similar quotes from him and Logan, Barr, and Kashkari, all talking about the same thing, that they see that rates are up and it's probably going to help do some of their work. Once these guys started talking, markets had recovered the initial reaction that happened from the Hamas attacks. And part of the reason that I think is happening is you show up and we look at, this is a 10-year average drawdown chart. So we're looking at average prices on the S&P 500 going back 10 years, and you see when we're drawing down, that's the market selling off, and you get back to zero is you've completed your drawdown. And you typically have drawdowns in March and September. We were in a strong seasonal sell-off in September. We're still in that. I circled that line in purple saying we're here, where typically there's a recovery in October. And what I think there's some seasonality traders, and they're looking at this saying, did this really affect what I'm going to do on my allocation? And in the short term, they said, or in the long term, they said no, and they started allocating, and all they needed was the Fed to say, we see what's happening. We don't need to keep raising
Which
rates.
is how we started out, right? The market is basically moving off interest rates, and they're looking at the Fed to understand what they're going to do with interest rates. If they're going to move up higher, then we need to sell off more to adjust for that. If we're going to stay level, well, we have a higher discount rate now. We just reviewed it at 10%. The market will stabilize and begin to rally at a faster pace than we initially had. And then if they're lowering interest rates, or may lower interest rates, we're going to see a market rally, right? We're back into a situation where bad news is good news, because that means the Fed is going to at least pause, if not reverse course, based off news. And I think that leads into the geopolitics. We try to avoid any political commentary whatsoever. Unfortunately, markets are affected by politics, and I don't think there's any difference here. The question is how much? And I never want to downplay the scenario or the situation from geopolitics. You know, it's a travesty with the Hamas assault. We send our prayers to all the individuals that are involved, especially innocent. We never want or think, I'm a Marine, you don't target women or children ever. Like that just isn't what should happen. But from a market standpoint, which is how we need to look at it, what's the impact going to be? And I don't think the impact is going to be that great. And here are, since 1940, when we have a significant geopolitical event, specifically a war act, what happens to the market? And I think you can really see a trend after the 80s. And there's kind of this mind shift within how the Fed is going to react, especially post September 11th, which is we're going to have government spending if there is a conflict. You're going to have more munitions, oil for war. It's going to tax the economy. And then the Fed is going to at least pause, if not lower interest rates, and other central banks are going to do so. So with this setup there's more chance that the Fed is going to have cover if inflation stays high, because there's a credible reason, which there's a conflict, and they're less likely to continue to raise interest rates, especially if the governments around the world are going to need to tap markets to pay for a conflict. So as horrible as this situation is, from a market standpoint, it isn't that bad. We typically see 6 months we're still in the green half the time. And any of the time that we're not, and especially the deep sell-offs, there's a more credible reason why. Let's take the Iranian general killed in an airstrike, January 3rd, 2020. And we can see we're down 23% over the next 3 months. I think there was another more credible reason on why we're down 23%, and that would be COVID. It had very little to do with this geopolitical event, no matter how catastrophic that event was. So even whenever we have these negatives, I don't think these geopolitical events are having a big impact, and I don't expect a large impact here. Now let's get to the catastrophe, where we get into a Middle Eastern war, where their energy prices are going up, etc. What are we going to do? Most likely the U.S. would be involved, and that's going to take a lot of government spending, and the Fed would likely also have cover for the reasons for inflation. Energy's high, it's not monetary policy, and they would begin to be more accommodative. The market would respond because now interest rates are lower. Plus the fear trade of people going to these securities. So I don't think we have to worry about trying to trade this scenario, and that's why we saw an initial blip during the assault, and then a rally, especially when that was confirmed by the Fed that, hey, we think rates are probably good, and we got that drop in probability of future rate hikes. We've been saying for a long time, if the Fed just pauses, that's all we need for the market to begin a new bull run. And I think that is a good explanation on why the market is behaving in a way where headlines are so scary.
Yeah. And when you get to, are you making any strategy changes based on this? And the answer so far is no. Right? We talked about last month that we're already allocating to energy, where we think there's a strong chance energy prices move up. This could even escalate that more significantly. We don't need to add energy right now. We already did.
Right.
And we also had a trade in strategies that are able to hold gold, and in the mode strategies where we were adding gold as well. unrelated to this. It may look like it was related to this. And gold, you get a safety trade that came with this, obviously, when this started happening as well. And so we already have made changes that were allocated correctly based on this.
Right, and it's just based on our signals. For whatever reason, those were moving up. Is it money that is already aware of situations or the risk? We're not sure. I know there's a little bit of voodoo to it, but it does work. It put us in these positions where we do have an overallocation to energy. We have added gold, all the things before the situation. So then what's our strategy going forward? Well, it's not in our slide deck this week, but it tends to make its appearance, which is where are we in the trend, or how far are we of the channel? And if we continue to be elevated and we're above channel, we'll continue to what we have been doing, which is continue to add to our cash bucket. We're at 18 months plus whatever is left for the quarter. If we remain higher, we will bring that back up. And that means we're getting really close to our goal of 24 months, so that if we do have a correction, we're well positioned for that. We don't want to aggressively abandon the market at all at this point, especially the way that it's been reacting. So we're just going to continue to follow our strategy and process. It's guiding us and navigating these markets well, and I think it'll continue to do so.
That's everything I had. The only other thing we haven't touched on is we're entering earnings season, and we'll talk a lot more about the effects of that and what's happening as we start getting some of those reports next month.
Well, we appreciate you tuning in, and if you enjoy Chris navigating these waters, please go ahead and hit that like button. Share it with your friends by hitting that arrow, and if you're not yet subscribed, hit that subscribe button so we can see you next month. Thanks, and we'll see you then.